Hi everyone, I am Mrs. P.KAVITHA, Assistant Professor of Economics, A.D.M. College for Women, Autonomous, Nagapattinam. Today my topic, money market and capital market. Now, meaning of money market. The money market is a short-term lending system. Borrowers tap it for the cash they need to operate from day to day. Lenders use it to put spare cash to work. The capital market is geared toward long-term investing. Companies issue stocks and bonds to raise money to grow their business. Now, define money market. The money market is defined as dealing in debt of less than 1 year. It is used primarily by governments and corporations to keep their cash flow steady and by investors to make a modest profit. The capital market is dedicated to the sale and purchase of long-term debt and liquidity instruments. Money market include markets for such instruments as bank accounts, including term certificate of deposit, interbank loans, that is loans between banks. Money market, mutual funds, commercial paper, treasury bill, and security lending and repurchase agreements. Now, significance of money market. Number one, liquidity management. Financial institutions, banks and other financial institutions use the money market to manage their liquidity needs, ensuring they can meet short-term applications. Corporations, companies utilize money market to manage their cash flow efficiently, investing surplus funds or borrowing to cover short-term needs. Then, safety and security. Money market instruments are generally considered low risk investments due to their short maturities and the high credit quality of issues. This makes the money market a safe place to park fund temporarily. Third one, monetary policy implementation. Central banks, like the Federal Reserve in the United States, use the money market to implement monetary policy by increasing short-term interest rate. This is achieved through open market operations, such as buying and selling government securities, etc. Now, interest rate. The money market rate serves as a benchmark for other interest rate in the economy, influencing borrowing cost and economic activity. Fourth one is financing government operation. Government issue short-term debt instruments such as treasury bill to finance their day-to-day operations and manage their liquidity needs without increasing long-term debt burden. Fifth one, efficient allocation of resources. The money market facilitates the efficient allocation of resources by channeling funds from entities with surplus capital to those with short-term funding needs, promoting overall economic stability and growth. Sixth one is price discovery. The money market helps in the price discovery process for interest rate, reflecting the supply and the demand and short-term funds. This information is crucial for investors and policymakers to make informed decisions. 7 to 1, risk management. Financial institutions and corporations use money market instruments to hedge against interest rate risk and manage their financial position. Now, functions of money market. Functions of money market with examples. The money market serves as a platform for short-term borrowing and lending of funds, facilitating liquidity management and ensuring efficient capital allocation in the financial system. The important functions of the money market include short-term borrowing and lending, price discovery, liquidity management, financing trade and commerce, reserve management for banks, etc. Now, in detail, short-term borrowing and lending. The money market is a platform for institutions to meet their short-term funding needs. Banks, corporations, and governments borrow money for a brief period, usually less than a year. This bridges gaps in the cash flow or fund immediate requirements. On the other hand, lenders provide these funds in exchange for the interest income. It allows them to earn a return on their surplus funds. For example, imagine a salary 5 lakhs for a new product launch. They borrow from a bank with the promises to repay the amount plus interest in 6 months. And the bank lends some excess funds to the startup, earning interest on the loan. Then, liquidity management. Liquidity management means investors seeking secure and easily accessible avenue for excess fund turned to the money market. Money market instruments are highly liquid, meaning they can be quickly converted into cash without significant loss in value. The liquidity feature ensures that investor can swiftly access their funds if needed. It makes the money market reliable options for managing short-term liquidity requirements. For example, an individual invests 5,000 in a money market mutual fund. Later, they face an unexpected medical expenses and need 3,000 urgently. They redeem their fund share quickly, accessing the needed funds due to the higher liquidity on the investment. Now, financing trade and commerce. In this money market function, the international trade is supported by providing financial solutions for exporters and importers. Instruments like letters of credit and banker acceptance facilitate cross-border transactions. Importers can use these instruments to assure payment to exporters, while exporters can obtain the funds before goods are delivered. This function promotes smoother trade activities and reduces the risk of international transactions. For the example, a country in the United States wants to buy machinery from a manufacturer in Germany. The US company obtained a bank acceptance to assure the Germany company of a payment. This instrument guarantees the payment will be made when the machinery arrives, promoting trust in cross-border trade. Now, reserve management for banks. Bank must maintain certain reserve to ensure their stability and compliance with regulations. The money market allows them to earn interest on these idle funds. Banks can optimize their reserve by investing in money market instruments and generate a modest return while fulfilling their regulatory obligations. And for the example, a bank holds 10 million in reserve to regulatory requirements. Instead of keeping these funds idle, the bank invests a portion in short-term instruments like treasury bills. This way, the bank earn interest on the reserve, optimizing their uses. Next one, yield enhancement. Investors seeking conservative yet yield investment options find money market instrument attractive. These instruments provide a moderate return compared to the traditional saving account or certificates of deposit. It makes them a preferred choice for individuals and organizations looking to enhance their yield without taking excessive risk. For example, an individual seeking better return than a standard of savings account invest 2,000 in a money market fund. This fund invests in various money market instruments. It offers a slightly higher yield with relatively low risk than traditional saving account. Now, central bank operation. Central bank utilize the money market to implement monetary policy measures. They buy or sell money market instrument through open market operation to influence the money supply and the interest rate. By adjusting these factors, central bank aim to achieve the economic goal such as controlling inflation, stimulating economic growth, or maintaining price stability. For example, a central bank reduces the money supply to control rising inflation. It sells treasury securities to commercial bank in exchange for cash. This reduces the available funds in the market, leading to increased interest rate and decreased spending. Now, risk mitigations. Corporations and financial institutions manage their interest rate and liquidity risk through the money market. Derivative and short-term financing operations are options such as repurchase agreements enable them to hedge against adverse market movement. These risk management tools enhance financial stability and enable business to navigate uncertain market conditions more effectively. For example, a corporation faces uncertainty due to fluctuating interest rate, which could impact its borrowing cost. The company enter into the interest rate swap in the money market to manage this risk. This agreement help the company exchange its fixed rate in interest payment for variable rate payment, mitigating potential losses. Now, support for government financing. Government raise funds for short-term budgeted needs by issuing treasury bill in the money market. These bills serve as a means of government to cover temporary deficit, manage cash flow fluctuations, and meet immediate financial operations. The money market provides a reliable source of funds for government while offering investor a secure investment options. For example, a government need fund for immediate expenses during a budget shortfall. It issues a treasury bill with a promise to repay the amount after a short period, securing necessary funds quickly and efficiently. Then, investor diversification. The money market broadens investment opportunities for individuals and institutional investors. Investors can diversify their portfolio beyond traditional stocks and bonds by participating in money market activities. This diversification aids in reducing overall portfolio risk and provide a balanced investment approach that align with varying risk tolerance and financial goals. For example, an investor aiming to reduce risk diversify their portfolio, they allocate a fund to different investments including money market fund. If stock market become violate the stability and liquidity of money market fund offer a secure anchor in their investment mix. Now the conclusion. Money market plays a crucial role in the financial ecosystem by facilitating short-term borrowing, lending, and investing. Its instrument provide flexibility, liquidity, and a benchmark for the interest rate. From governments funding urgent needs to the business managing day-to-day operations, the money market bridges immediate financial requirements and available funds. This dynamic marketplace ensures the economic stability, efficient cash flow, and investor opportunities. This is done to serve and grow their funds while supporting the overall functioning of the financial system. Now, capital markets. Then the meaning of capital market. Capital market is a place where buyers and sellers engage in trade, buying and selling of financial securities like bonds, stocks, etc. The trading is undertaken by the participants such as individuals and institutions. Capital market traded mostly in long-term securities. Capital market is a place where buyers and sellers indulge in trade, buying and selling of financial securities. The trading is undertaken by the participants such as individuals and the institutions. Capital market trade mostly in long-term securities. The magnitude of a nation's capital market is directly interconnected to the size of its economy, which means that ripples in one corner can cause major waves somewhere else. Types of capital market. There are two types, that is primary and secondary. Primary market. Primary market means market for new shares or securities. A primary market is one in which the company issues new securities in exchange for cash from an investor, that is buyer. It deals with the trade or new issues of stocks and other securities sold to the investor. Secondary market. Secondary market deals with the exchange of prevailing or previously issued securities among investors. Once new securities have been sold in the primary market, an efficient manner must exist for the resale. Secondary market give investor the means to resell, trade existing securities. Another important division in the capital market is made on the basis of the nature of the security sold or bought. That is stock market and the bond market. Now, elements of a capital market. Market sources of funds include individual investors, financial institutions, insurance companies, commercial banks, business, and retirement funds. Investors invest money intending to make capital gains as their investment grow over time. They also receive dividend interest and ownership rights. Fund seekers include companies, entrepreneurs, government, etc. For example, fund the economy and development project, the government issue bonds and deposits. These markets usually trade long-term investments such as stock, bonds, debenture, and government securities. Moreover, securities like convertible debenture and preference shares are available. The market is primarily operated by the stock exchange, brokerage firm, investment banks, and venture capitalists or other intermediaries. The regulatory bodies are responsible for monitoring and eliminating any illegal activities in the capital market. Securities and Exchange Commissions, for example, overseas stock exchange operations. Now, functions of capital market. Number one, links borrowers and investors. Capital markets serve as an intermediary between people with excess funds and those in need of funds. Capital formation. The capital market plays an important role in capital formation. By timely providing sufficient funds, it meets the financial needs of different sectors of the economy. Regulate security prices. It contributes to security stability and systematic pricing. The system monitor whole processes and ensure that no unproductive or speculative activities occur. A standard or minimum interest rate is charged to the borrower. As a result, the economy security price stabilizes. Then provides opportunity to investors. The capital market have enough financial instrument to meet any investors' needs, and the capital market also provide investors with the opportunity to increase their capital yield. The interest rate on most saving accounts is extremely low compared to the rate of equities. Minimize transaction cost and time. Long-term securities are traded on the capital market. The whole trading process is simplified and reduced in cost and time. A system and program automate every aspect of the trading process, thus speeding up the entire process. Capital liquidity. The financial market allow people to invest their money. In exchange, they receive ownership of a stock or bond. Bond certificate cannot be used to purchase a car, food, or other assets. So, they may need to liquidate it. Investor can sell their asset for liquid funds to a third party on the capital market. Now, importance of primary and secondary market in India. In India, primary and secondary market are crucial for the economy. The primary market helps companies raise money for growth and innovations by issuing new shares and bonds. The secondary market allows the investors to buy and sell the securities easily, providing liquidity and determining prices based on supply and demand. Both market gives various investors from the individuals to institutions opportunities to invest, and the economic growth by channeling capital to the businesses and encouraging investment, which boost overall economic activities. Then capital market instrument. Capital market in India are crucial for helping business and government raises long-term funds. They consist of the various segment and financial instrument to meet different invest needs and risk operate. Number one, stock exchange. BSE, Bombay Stock Exchange. One of the Asia oldest Bombay Stock Exchange allow trading in stock derivative and mutual fund. It listed thousands of companies. Then NSE, National Stock Exchange. India's largest stock exchange, NSE, is known as for the Nifty 50 index, tracking to top 50 companies. Equity market, primary market. This is the new stock or first sold. Companies raise funds through the initial public offering, the follow and on public offering. Secondary market, traded here, for example, shares of Reliance Industries and Infosys are bought and sold the Bombay Stock Exchange and the National Stock Exchange. Then debt market. Corporate bonds, companies issued bonds to raise capital. This can be traded later, for example, bonds from the Tata Motors and Reliance Industries. Government securities. Government securities issued by the government to cover its budget deficit. For example, treasury bill and long-term bonds are included. Then derivative market. Future and options. Contract based on the asset like stock and indices. National Stock Exchange offer these contracts for the indicator like Nifty 50. Commodity derivative traded on exchange like MCX and NCDA, DEX. These included future contract for the gold, silver and the agricultural products. Then mutual fund. These funds pool money from the investors to buy a mix of stock, bonds and other assets. Major fund houses include the HDFC and the ICICI Prudential. Then foreign portfolio investment. Foreign investor invest to the Indian stock, bonds and derivative, adding to the market liquidity. Then alternative investor funds. These include venture capital and private equity funds, catering to high net worth individuals and the institutions. Regulations, SBI, SEBI, Security Exchange Board of India. Overseas stock exchange and mutual funds to the protect investor. RBI, Reserve Bank of India, manages government securities and foreign exchange market together. These elements support India financial growth and investment opportunities. Then conclusion, capital market play a very important role in the financial industry. They connect capital suppliers with those seeking aid. The funding may come from the government, business or even individuals who want to buy a home. These markets help move money from people who have it to people who need it. Thank you.